So flex market this is roughly the way we think about how it works. We want to work with you, get you guys engaged, and we'll talk a little bit more about what we call a flexibility purchase agreement, an FPA. So which says we're going to pay you, or it's really the investor-owned utility with these market access funds are going to pay you for the value of the flexibility that you deliver to your customers, measured at the meter. And your customers get to keep their benefits, but and that is what if we look at this kind of right-hand side, the business model, the tech, the financing, how you go to market, that's all you guys. We can do some things to help identify which customers are best, things like that. But at the end of the day, we want to leave you all to figure out in your own customer and your own business model. You engage those customers, which is again, we're essentially invisible in the background. They know we're here, but ultimately this is a value they could not otherwise monetize. You're free to take that cash flow and turn it into a discounted offering to the customer, lower interest rates, better marketing, better margins. It's up to you. You engage those customers, you help them shift load out of peak or insulate an attic where there's a bad air conditioner running too hard, or replacing that air conditioner with a heat pump, whatever that is. We're going to then track the impact that you had to the demand at that customer site, rolling that up into all of your customers. And that's what we think of as a virtual power plant, is that aggregation of your customers. And then be able to get you paid for that grid benefit like a power plant on the back end. And so that, again, that payment flows from the counterparty, the utility, focused on those peak reductions, to the aggregator, based on how you actually perform over the course of a year, measured performance. And that measured performance piece is really important. There's a tremendous amount of business opportunity in getting paid for what you deliver, not getting paid for averages. And I just want to give some basis for that. This is an example. This is messy reality on the top, and this is deemed models on the bottom. And so this is an example of an actual portfolio we're looking at, where the deemed values in this commercial portfolio assume everybody peaks in the middle of the day, but we're measuring morning and evening peaks, which are tremendously more valuable to the grid. And so this portfolio, is $48,000 more valuable just by calculating the actual impact. When we can talk about some things that will dramatically increase that value. If for example, you target the customers, let's say you're doing an HVAC related project, let's see, HVAC, shell, controls. If you can figure out which customers use the most HVAC energy during the peak periods we care most about, those customers can be 2-3 times more valuable to you and the grid. And so not getting stuck with the average produces tremendous opportunities for your businesses to really drive significantly new margins, right? By selecting for the technologies and the customers that actually deliver the most outcomes, and not being stuck with that average load shape impact that we use in our traditional programs.